Ladies and gentlemen, today I want to speak plainly about something many of you are considering: selling your silver right now. You may have heard it's a golden opportunity, that prices are high, demand is rising, and you should get what you can when you're making financial decisions, especially decisions that involve something as emotionally charged as selling an asset you've held for years. You have to strip away the noise and the hope driven narratives that cloud judgment. Hope is comforting, but it's also deceptive. Reality is often uncomfortable, but it's the only solid ground you can stand on. And if you don't anchor your decisions in reality, you end up paying a price for it, sometimes immediately, sometimes years later, but the bill always comes. Reality means looking at what is, not what you wish it would be. That sounds simple, yet most people don't do it. They react to the excitement of rising prices, the anxiety of falling markets, or the persuasive voices of people who may not even understand the systems they're commenting on. They build narratives: silver is up, so it must be the right time to sell, or I need cash, so I should unload what I have, or everyone else is selling, so I should too. These aren't decisions, these are emotional impulses dressed up as logic. You want to make progress, financial or otherwise, you have to train yourself to recognize that pattern and step out of it. The first discipline is separating what you know from what you're guessing. You might feel like selling silver is a good move right now, but what do you actually know? You know the true state of the silver market, not headlines, not commentary, but actual supply and demand dynamics. Do you understand investor positioning, industrial demand cycles, monetary policy influences, and where the asset sits in its long-term cycle? Most people don't. They skip that part because it's complex and complexity is uncomfortable, so they revert to hope. I hope I'm making the right choice. But hope is not a strategy, it's not a foundation, it's a patch. Reality requires the opposite approach: brutal clarity. You have to confront the facts even when you don't like them. Maybe the market hasn't reached real value yet. Maybe dealers are offering far less than the asset's true worth. Maybe you're being driven by immediate financial stress, which pushes you into a decision you'll regret when circumstances stabilize. Maybe macroeconomic signals suggest that selling now will cause you to miss the next upward leg in the cycle. These are uncomfortable possibilities, but they are real possibilities, and if you don't examine them, you are choosing blindness over insight. Another dimension of reality is understanding incentives, yours and everyone else's. People will tell you to sell, to buy, to hold, to panic, to relax. But why? What incentive drives their advice? Dealers make more when you sell in fear. Analysts make headlines when they push dramatic narratives. Social media thrives on exaggeration. If you don't question motives, you risk confusing someone else's incentive with your own best interest. And when you mix incentives without understanding them, you become part of someone else's strategy instead of the architect of your own. Reality also shows you long-term consequences, while hope focuses on short-term relief. Selling silver now may solve a momentary need, but what does it do to your long-term position? If inflation persists, if currencies weaken, if economic instability grows, assets like silver often gain value precisely when people underestimated them. Selling too early might give you a small benefit today, but cost you significantly more in lost opportunity. You need to be aware of that trade-off. You need to quantify it. You need to visualize it. That's what it means to base decisions on reality. This approach demands humility. You have to accept that you don't know everything and that your feelings, while real, may not be reliable. Humility isn't weakness. It's the door through which real understanding enters. When you acknowledge what you don't know, you make space to learn. When you recognize how easily emotions distort judgment, you create the possibility of clearer thinking. That clarity is what protects you from expensive mistakes. If you truly want to make rational decisions, you have to step back from the emotional noise and examine your reasons without bias. Ask yourself, if I removed my fear or excitement, would I still make this decision? If the answer changes when you strip emotion away, then your choice wasn't grounded in reality, it was grounded in hope, and reality always wins in the end. When you discipline yourself to see the world as it is, not as you want it to be, not as you fear it to be, you unlock better decision making. You stop being reactive and start being strategic. You stop being swayed by temporary circumstances and start building long-term resilience. And ultimately, that's what makes the difference between people who preserve their wealth and people who lose it without understanding how. Why? Most people make decisions based only on what they can see directly in front of them. They look at the surface, the price on the screen, the offer from a dealer, the short-term cash they think they'll gain. But the truth is that the real cost, the one that shapes your financial life, is almost always hidden beneath that surface. If you don't train yourself to recognize structural disadvantages, hidden costs, and opportunity costs, you'll consistently underestimate the true impact of your choices. And when that happens, you may think you made a logical decision while in reality you walked straight into a disadvantage you didn't even know was there. When someone sells silver or any asset without understanding these underlying factors, they often leave value on the table. They think they're getting a good deal because they're receiving cash, but they underestimate what they're giving up. Structural disadvantages exist in every market, and the silver market is no different. The spreads between buying and selling are built to benefit the dealer, not you. The premiums you once paid won't be returned. The price you see on the chart is not the price you will receive. The system is designed that way. If you ignore this structure, you're operating with a blind spot, and blind spots are expensive. One of the biggest hidden costs is the spread, the gap between what your silver is worth on paper and what someone will actually pay you for it. If spot price rises, you may assume you're gaining, but if the spread grows or the dealer offers significantly below spot, your actual gain shrinks. Many people never calculate that gap. They celebrate the price increase without running the math on how much of that increase is lost to transaction structure. That is a silent disadvantage, and silent disadvantages are the most dangerous because you don't feel them until it's too late to reverse the decision. Then there are fees, commissions, taxes, and sometimes even penalties depending on how and where you sell. These aren't just small inconveniences. They can meaningfully erode your profits. You believe you're selling at a good price, but by the time these hidden layers finish eating into your return, you may find that the gain you thought you achieved is far smaller or even non-existent. The worst part is that many of these costs aren't obvious at the moment of decision. They show up later, quietly, when you can't do anything about them. But hidden costs alone don't define the disadvantage. Opportunity cost is just as critical and often more overlooked. When you sell an asset, you're not just losing the asset, you're losing the potential future value of what that asset could become. You're also losing the opportunity for that asset to protect you during times of instability. If silver rises further, if inflation hits harder, if currencies weaken, or if geopolitical uncertainty increases, the asset you sold might have offered greater value than the cash you received. That gap, the difference between what you gained and what you could have gained, is the true cost, and most people never calculate it. Opportunity cost also applies to what you do with the cash you get from selling. If you don't have a high return plan, a clear, thought-out, rational plan for reinvestment, the cash you receive may end up sitting idle. Cash loses value over time. Inflation, even at moderate levels, ensures that the money you choose to hold today will buy less in the future. So you gave up a hard asset with long-term stability, a form of value that erodes silently. That's another structural disadvantage. You exchanged something resilient for something fragile without realizing the trade was rigged from the start. Most people make these decisions because they only calculate visible gains and ignore invisible losses. They look at the quick benefit and overlook the long-term consequences. They accept the dealer's offer without questioning the structure behind it. They focus on short-term convenience instead of the long-term mathematics. Whenever you operate like that, you're operating at a disadvantage, even if it feels like you're making progress. The only way to protect yourself is to slow down and analyze the full picture. Ask, what is the true cost of selling? What am I losing beyond the asset itself? What advantages does the buyer gain that I'm giving up? What is the value of keeping this asset through the next market cycle? What will I do with the cash, and will it outperform what I sold? These questions pull hidden costs into the light and expose the structural disadvantages that would otherwise trap you. When you start thinking this way, you no longer get fooled by simple numbers or short-term gains. You stop falling into the traps built into the system. You recognize that every decision comes with unseen consequences. And once those consequences become visible to you, you can navigate markets more intelligently, more strategically, and with far more control over your financial outcomes. Most people make decisions as if the world is fixed in the moment they're living in. They see today's price, today's stress, today's need for cash, and they build their choices around those immediate pressures. But the world doesn't operate in moments, it operates in cycles. Everything moves in patterns. Markets rise and fall. Inflation accelerates and cools. Currencies strengthen and weaken. Demand shifts from one sector to another. If you don't recognize these cycles, you anchor your decisions to the present instead of the broader arc of reality. And when you do that, you almost always sacrifice long-term value for short-term comfort. Thinking in cycles means stepping back far enough to see the rhythm. Every asset, silver included, goes through phases. Sometimes it underperforms, sometimes it explodes in value, sometimes it stalls. None of these phases last forever. When you only focus on what's happening right now, you treat temporary conditions as permanent truths. If the price is stagnant today, you assume it will stay that way. If you need cash now, you assume selling is the only solution. Those assumptions trap people into decisions that feel rational in the moment but prove costly when the cycle inevitably shifts. The real question isn't, what do I need right now, but where does this asset sit in its long-term cycle? If silver is currently undervalued, selling it now means you're locking in the bottom portion of the cycle, essentially trading potential upside for immediate liquidity. If the macro environment is shifting toward inflation, monetary instability, or increasing industrial demand, you're selling an asset right before it becomes more valuable. That's the danger of focusing on cash today without considering value tomorrow. This isn't about predicting the future perfectly. No one can do that. It's about understanding probabilities based on historical patterns. Over long horizons, hard assets tend to outperform when fiat currencies face pressure. They tend to rise when global uncertainty increases. They tend to gain when supply contracts or industrial use expands. These are not opinions. These are recurring structural behaviors. If you understand the cycle you're in, you can judge whether selling aligns with reality or contradicts it. Thinking long-term also means recognizing the alternatives available to you, not just the immediate transaction. Selling silver isn't just about giving up the asset. It's about choosing one path over another. So you need to ask, what am I exchanging it for? If you're selling simply to hold cash, you're making a trade you may not realize you're making. You're swapping a long-term inflation hedge for a medium that loses value every year. That's not a neutral move. That's a shift from resilience to vulnerability. Many people don't see it because cash feels safe in the moment. But over time, the cycle punishes cash holders far more consistently than asset holders. The better way to think is in terms of alternatives. If you truly need liquidity, can you generate it another way? If you want to invest, are there options that offer higher returns without forcing you to sell an asset at the wrong point in its cycle? If you want stability, does selling actually bring you stability, or does it weaken your long-term position? These questions broaden your perspective. They force you to evaluate choices not through the lens of urgency, but through the lens of strategy. Cycles reward patience. They reward those who can delay gratification, who can hold assets through temporary discomfort, and who can see beyond the reaction-driven behavior of the crowd. When everyone else is selling because they're focused on their short-term needs, you gain an advantage by focusing on long-term positioning. Markets consistently transfer wealth from the impatient to the patient. That transfer is not random. It is the natural outcome of how cycles operate. Thinking in alternatives also means not being fixated on just one solution. If you believe selling is the only option, you haven't explored enough. Real decision-making requires understanding the full landscape, keeping the asset, partially liquidating, refinancing, reallocating, building income streams, or even simply delaying the decision until conditions improve. The world always offers alternatives, but you won't see them if your mind is crowded with short-term pressure. When you zoom out and look at the broader cycles, selling an asset like silver for immediate cash often becomes one of the least strategic choices you could make. Not always, but far more often than people realize. Why? Because short-term needs fade, but the consequences of selling at the wrong time endure. What feels urgent now will feel irrelevant later, while the value you sacrificed will become painfully clear. If you discipline yourself to think in cycles and alternatives, you stop being pushed around by the pressures of the moment. You make decisions that align with where the world is moving, not where it happens to be today. That shift from short-term reaction to long-term perspective is what separates those who build lasting financial strength from those who repeatedly trade their future for immediate relief. Most people move through the world assuming that what they've been told is true, that what the majority believes must be right, and that the conventional path is the safest one. But conventional wisdom is often just unexamined belief, a collection of assumptions repeated so many times that they start to sound like truth. If you accept those assumptions without questioning them, you end up making decisions that aren't really yours. You follow the herd without understanding where the herd is going or why. Being radically open-minded isn't about rejecting everything. It's about being willing to question everything, including your own thinking, especially when the stakes are high. Open-mindedness begins with acknowledging the simple fact that you don't know everything. No one does. The moment you believe you're certain, you close the door to learning, and that's when mistakes become inevitable. When you tell yourself, "I know enough," you blind yourself to new information that could reshape your understanding. If you want to make better decisions, financial, personal, strategic, you have to train yourself to seek out perspectives that challenge your assumptions, not just those that confirm them. Selling an asset like silver is a perfect example of where conventional thinking often leads people astray. The typical narrative is simple: prices are up, so selling now is smart. Or everyone's selling, so I should too. Or holding too long is risky, so better to exit while you can. These ideas sound logical because they're familiar, but familiarity has nothing to do with truth. The fact that many people believe something doesn't make it right. Often, the majority gets things wrong at Precisely the wrong time, the top of a market, the bottom of a cycle, or the moment when emotions are clouding judgment. To be open-minded, you need to look at the opposite argument with seriousness, not dismissiveness. Ask yourself, what if the popular advice is wrong? If the common belief is to sell, explore the possibility that holding is actually more advantageous. If others are panicking, consider the value of patience. If people assume the current price is the final destination, ask whether the cycle suggests otherwise. By examining the opposite viewpoint, you expose blind spots in your thinking. Those blind spots often contain the very information you need to make a stronger decision. Being open-minded also requires seeking information from people who disagree with you, not to argue with them, but to learn from them. You're not looking for confirmation, you're looking for insight. Someone who challenges your assumptions may reveal risks you didn't see or opportunities you hadn't considered. When you avoid opposing views, you become trapped in an echo chamber, and echo chambers create false confidence. That confidence feels good, but it's dangerous because it isn't rooted in reality. Reality doesn't care about confidence, it cares about accuracy. Another aspect of radical open-mindedness is being able to separate your ego from your decisions. People often defend their ideas not because they are correct, but because they feel personally connected to them. When your identity is tied to your beliefs, questioning those beliefs feels like an attack. That emotional attachment makes you resistant to new information, even when that information could save you from a bad decision. If you want clarity, you have to detach your sense of self from your opinions. You need to be willing to say, I might be wrong, without feeling threatened by that possibility. Challenging conventional wisdom doesn't mean being contrarian for the sake of it. It means applying a deeper level of reasoning than most people are willing to. It means understanding that conventional wisdom is often built on short-cuts assumptions that ignore complexity because complexity takes effort. If you're willing to go deeper, to explore the underlying mechanics, you gain an advantage over those who act on surface-level thinking. That advantage compounds over time, especially in markets where the most obvious answer is rarely the most profitable one. You also need to consider incentives. Why is a particular belief so widely accepted? Who benefits from people acting on that belief? If a narrative encourages widespread selling, ask who gains from that selling: dealers, institutions, market makers. Often, popular narratives exist because they serve someone's interest. If you don't trace the incentives, you're vulnerable to becoming part of someone else's strategy instead of pursuing your own. Being radically open-minded means building a habit of challenging your default reactions. When you feel urgency, pause. When you feel certainty, investigate. When you feel influenced by the crowd, step back. This isn't natural, it takes discipline, but with practice, it becomes one of the most powerful tools you can develop because it helps you bypass emotional traps and see the world more as it is, not as others present it to be. If you can cultivate that mindset, you'll make decisions that are more grounded, more strategic, and more independent. You'll be less vulnerable to fear-based narratives, herd behavior, and market noise. You'll gain clarity in situations where others feel confusion, and ultimately, you'll protect yourself from the costly mistakes that come from following unexamined beliefs. Being open-minded doesn't mean believing everything. It means questioning deeply, understanding fully, and choosing intentionally. That's how you build long-term strength in a world filled with short-term noise. Ultimately, your strength comes from questioning assumptions, not following them. When you stay open-minded, challenge popular beliefs, and examine every angle honestly, you make clearer, smarter decisions. This mindset protects you from emotional mistakes and positions you to recognize opportunities the crowd overlooks. That's how you secure long-term advantage.